Yeah. And one caveat, I think it's important to make one caveat. We've made a lot of progress on safe. I don't think we're home and dry yet, Zubin, but I think finally the regulators are at the party. So finally, it's all kind of coming together essentially into like a digital wallet that's sort of, it's equivalent of, you're waiting to buy the Godzilla figurine that a young Zubin would have craved since Shusuke Kaneko made GMK in
I mean,
2001.
okay, we've gone down a Japanese rabbit hole right now. I think Aman is a bit.
I love my rabbit hole. Welcome back to A to Z FinTech, the show where we decode the biggest shifts in finance, tech, payments, and everything in between. I'm Aman.
And I'm Zubin, fresh off the plane from Japan.
Konnichiwa, Zubin. How was it?
Konnichiwa, magical. Shibuya crossing at night, ramen at 2 a.m. And yes, I came back with a bag full of capsule toys and that Godzilla figurine that rose when you press its head.
Look, it looks like you went on holiday, got some jet lag, but the real takeaway is you've invested heavily in vending machine futures. We were there, Zubin, earlier this year for ski season, and my daughters went totally long on Sanrio, specifically Kuromi.
But here's the thing. Japan has perfected miniaturization. Whether you're talking capsule hotels, bento boxes, or take something bigger and make it neat, portable, and perfect. And they do a really, really good job about that.
I know. I wish they could do that with human beings. Look, funny you should say that because it is exactly today's topic. Tokenization, the Japanese art of miniaturization, but for financial services.
Spot on. I'm excited to dive in. But before we do, a quick disclaimer. This podcast is for information and entertainment purposes only. It's two dudes riffing. We've talked about it. It's our own views, not of any organizations that we are affiliated with. And we're definitely not offering financial advice. So with that out of the way, let's dive into it.
So today, tokenization gets lumped in with cryptos, NFTs, and Web3 hype. But the first mainstream commercial use cases, Zubin, were payments. Your and my favorite topic. And not just blockchain payments, but, old school card payments. Tell us more.
You're absolutely right, Aman. And, in the context of securing online payment transactions, if I go back to those initial use cases of card tokenization, I think they first emerged in, I want to say 2001 with a company called Trust Commerce that really pioneered card tokenization to help one of their clients, which was classmates.com, protect sensitive card information. Now, you have to remember this. This is 2001, early days of the internet. There were legitimate concerns around online fraud. And in fact, if we take this one step further, like PayPal also sort of capitalized on this trend by enabling customers to store their credit card information with PayPal and complete an online transaction without ever sharing that credit card with a merchant, also known as tokenization.
And fast forward to the early 2010s, fraud was spiking, data breaches were making headlines. Zubin was, drinking too much beer. But also, we were storing 16-digit card numbers. It was like leaving your front door open with a sign saying, please rob me.
2010s was definitely the decade of Zubin with fruity drinks with the umbrella on top. But anyway, we totally digressed. Many of you might remember this, or maybe not, but our alma mater, Google, devised the Proxy tokenization solution by buying TXVR. For any card that was essentially loaded in your Google Wallet or Google account, Google replaced that with a MasterCard virtual card and used that Proxy card to complete a transaction with any Google Wallet integrated merchant. In fact, Instant Buy, as it was called, was the first product that I worked on when I joined Google in early 2014. What was brilliant about it is that it worked seamlessly with the merchant's existing integration. They didn't need to change anything with their downstream payment services. Users were really, really happy because none of those card details were shared with the merchant. They stored that with Google. Google shared that Proxy card. But issuers and the payment networks absolutely hated it because Google was disintermediating them with that Proxy card.
In fact, Zubin, around the same time, you also had companies like Stripe who were developing their own proprietary tokens so that mobile app developers didn't have to manage the messiness of PCI compliance. And they could go accepting payments with 12 lines of code or whatever. Yeah.
No, spot on. And I'll also take this one step further, right? Like, all this really meant that there were these competing standards for card tokenization. And again, going back to that 2010, 2011, 2012, Apple was also starting to work on their own payment solutions. So, to give the payment networks a lot of credit, and we've done that in the interchange conversation as well, they saw this as the catalyst to launch network tokenization standards. And really, what network tokenization standards in the context of card is replacing that 16-digit card number that is embossed on your plastic card with a unique, non sensitive token that is managed by the payment networks.
You know, as we talk increasingly about the realism of 16-digit cards moving on, it's quite surreal. Look, even if a merchant at that go back in time, even if a merchant got hacked, the token was useless anywhere else. And because Visa and MasterCard already ran the Shinkansen tracks of global payments, they could deploy it at scale, making tokenization a more interoperable and dynamic solution across payment ecosystems. When you say that,
Yeah, no, you've already used the three words I know in Japanese, though Shinkansen is mostly the English word out there. But scale is the key. And that's what really set the stage for that next leap, right? Like, so far we've been talking about cards in the context of cards, but like putting tokens in things that weren't cards at all was, I think, that next stage of growth.
yeah. Once Visa and MasterCard had the distribution network tokenization, then that's where the magic started to happen, right? Zubin, those secure tokens could live anywhere. For mobile wallets like a Google or Apple Pay, the big unlock was not NFC. The tech was old news. It was the phone didn't store your real card number. It stored a device-specific network token issued by Visa or MasterCard.
No, and I'll take that one step further. Those tokens were cryptographically tied to the device and the issuing bank. For those of you who have a mobile wallet, whether it's Google or Apple, you've gone through that step where you set up your cards for the first time. You get that OTP. You tie it to your device. Those devices are cryptographically tied to your device. And you lose the phone, that token is nuked instantly. So there's no worry
And
about
that, Zubin, I was in banking, then that gave banks the confidence to approve contactless payments via phone. Without that, the trust and adoption would have stalled.
spot on. And globally, that flipped a switch, right? Suddenly, anywhere you could tap a Visa or a MasterCard, you could tap your phone, whether it was hawker stalls, high-end malls, or even the Tube or the MRT, you're ready to go.
Yeah, and like Japanese capsule hotels, compact, efficient, delightful, payments shrank from a 30-second ritual to a sub-second one.
Love it, love it. All right. So payments was Act 1. Act 2, from our perspective, was really the non-fungible tokens, or NFTs.
So it's 2014. Apple Pay has just launched, and coincidentally, the first NFT named Quantum, when it was launched with a professor, I think an artist, Kevin McCoy, who paired up with the tech exec, Anil Dash, now infamous for the 7-on-7 hackathon.
Yeah. And at first glance, the world of global payment standards and digital art collectibles appear to be almost entirely separate. But, while EMVCo tokens were born out of this specific need for security, the payment industry, its innovative use of digital identifiers, I think from our view, can be really viewed as the conceptual precursors to this broader and more abstract application to non-fungibility that essentially applies to NFTs.
And I think NFTs introduced the idea of using blockchain technology to tokenize unique assets.
Exactly. And while these initial NFT use cases were primarily in sort of digital art or collectibles, and again, it's debatable, right? Like how much interest, they demonstrated the power of a public, immutable ledger to represent managing ownership of something that wasn't currency, right? This concept of tokenized assets is a direct predecessor to tokenization of real world financial assets.
So talking about Japan, while you were on a holiday, I was reading about this and coincided with your vacation. A skyscraper in Osaka was tokenized recently by MUFG in a move that offered digital security to both institutional but as well as retail investors. This basically what it involves, Zubin, was a high-rise building. I don't know if you saw this. Got tokenized for it was 100 billion yen, but 680 million US, and that created digital securities of tokens that represented ownership in the whole building. The initiative essentially was part of a broader trend, I think, and it's kind of sort of becoming zeitgeist in Japan, and sort of more globally towards tokenizing essentially real world assets like real estate.
Like seriously, like, you know, it's like suddenly owning Tokyo real estate isn't just for ultra high net worth individuals or institutions.
Yeah. No, and it's just and it's not just property, right? Like tokenized assets are like, if you think about digital tokens on blockchain that represent ownership of a tangible financial asset, this could include anything. It could be gold, it could be fine arts, stocks, bonds, money market funds. I'll give you an example. Robinhood recently launched tokenized versions of over 200 US stocks and ETFs for its European customers. Essentially, by representing a share of the asset as a token, it can be easily and quickly traded 24/7 on a blockchain network, and the ownership history is transparent. It allows for essentially for fractal ownership and makes like not just buildings in Japan, but high value stocks or assets acceptable to sort of a wide range of investors.
No, that makes a lot. So we've talked about sort of tokenization starting with payments, touched on NFTs, and then sort of expanded to this real world assets, the skyscraper in Japan. But there's this almost this critical middle piece here, which is really tokenized deposits. And to me, that's sort of, again, going back to our conversations about this conversation of tokenization, it's that bridge between the old banking world that you and I have sort of lived and the new one that we seem to be driving towards.
Yeah, I think this is something that we, did a bunch of work on at Google when we were there. And exactly, this is the, think of this as a way, um, okay, let's think about it this way. Like tokenized deposits are not just some new kind of crypto, they're a digital representation of good old commercial bank money. For example, in fact, I was just talking to somebody from there. A bank like JP Morgan has launched JPMD, a tokenized dollar deposit that lives on the blockchain, right? In this model, a regular or regulated bank issues a token on blockchain that represents a dollar that they hold in traditional accounts.
Yeah, and I mean, you're spot on, right? Aman, it's like this digital receipt of a dollar that you already have in your bank, and it's inherently has all the trust, the insurance, the legal clarity of the existing banking system. But now you have all the benefits of being on a blockchain. So
and it's
really
like
key part. Yeah,
it's institutional grade version of like essentially the stable digital asset, right? That's why I think the stage is set for the big one, the consumer facing sort of stablecoin craze.
I love it. I love the fact that you use Craze. But why do we call it Craze? Because, really for the first time, people have a way to get on chain without the risk of the money disappearing overnight in a market crash.
And stablecoin issues like Tether and Circle took that essentially the core idea of tokenized or fiat based liability and made it hyper liquid and accessible. Their tokens like USDT, USDC are basically tokenized reserves, a stand-in for for a dollar that can move instantly across the blockchain.
Yeah, and add to that, that's the single biggest hurdle to crypto adoption has been the volatility. So addresses that spot on.
Precisely. I mean, by providing a stable medium of exchange, Zubin, stable coins were on a sort of like were the on ramp for millions of people into the crypto ecosystem. They let you trade, transact, and even use DeFi applications without being exposed to the sort of wild swings of Bitcoin or Ethereum. I guess it's the end of a long, deliberate journey from, like early clunky experiments to this more polished, more widely adopted solution.
Yeah, and this sort of progression makes perfect sense, Aman. And maybe, we came up with this progression. Seems natural out there. The first was like the nerds that sort of proved it out technically possible with that payments and likely the digital assets use case. Then the banks proved it was sort of institutionally viable with tokenized deposits. And finally, the fintechs come along with stablecoins and made it simple, safe, and useful for everybody. So that whole journey has been blending blockchain innovation with the stable trust of fiat money, with tokenization being the core of it.
Yeah. And one caveat, I think it's important to make one caveat. We've made a lot of progress on safe. I don't think we're home and dry yet, Zubin, but I think finally the regulators are at the party. So finally, it's all kind of coming together essentially into like a digital wallet that sort of, it's equivalent of, you're waiting to buy the Godzilla figurine that a young Zubin would have craved since Shusuke Kaneko made GMK in 2001.
Okay, we've gone down a Japanese rabbit hole right now, I think.
I love our rabbit holes.
And let's shift gears a bit. Let's zoom out. Tokenization is the duct tape of the next generation of financial stack, right? Like holding security, scale, and sort of accessibility sort of together in that context.
Yeah, I think it's a little bit more sturdy than duct tape. In payments, it shrinks a card into secure snippets of code. In wealth, it's shrinking a skyscraper into a tradable asset. And tomorrow it might sort of shrink an entire portfolio into programmable, portable assets that you can move with a single click.
Yeah, which means sort of finance can be embedded anywhere, right? Like whether it's super apps, cars, games, essentially without leaking risk.
Yeah. Zubin, can I share a theory I've been working on since we started this, looking at tokenization?
All right, here we go. It's going to be another Aman mic drop, right?
I don't, you tell me, but we've spent this whole episode talking about tokenization, but I think it's just one of three tectonic shifting plates, if you'd like, in finance. I think the second is decentralization, Zubin, pushing trust, governance, and infrastructure out of single control points. Done right, it's not just redundancy, it's resilience. It's a world where no one can quietly rewrite history or freeze the pipes or change the rules on a whim. It's what lets innovation happen at the edges without breaking the core. The third, the one that we rarely talk about and doesn't really have a word, so let's call it contextualization. Contextualization. Today we obsess about KYC, know your customer. Tomorrow we'll have to move to KYT, know your transaction. Some people are already doing that. Not just for who's sending and receiving, but what's the intent? Is the data real or is it synthetic? Is this an original asset or is it a derivative? Because in a world where AI can spin up a fake invoice, fake identity, fake transactional histories, contextualization, I said it, is how we separate the signal from the noise and prove that the signal is real. So here's how it all comes together. These three primitives, tokenization, decentralization, contextualization, aren't pillars. They're a flywheel. Tokenization makes things machine-readable. Decentralization makes them resilient, permissionless. And contextualization makes them trustworthy and meaningful. Once that sort of wheel starts spinning, new capabilities start to cascade, Zubin. Programmable money, microtransactions, interoperable markets, privacy-preserving sort of compliance and autonomous agents. We talked about that, acting with cryptographic proof. And when those capabilities exist, 1,000 flowers can then bloom. Fractionalized real estate assets, cross-border streaming of payroll, instant provenance checks at a point of sale. The primitives set the bedrock, Zubin. The capabilities are the topography. The features, That's the stuff that the buildings and people that we construct on top of them, but the ground beneath is being poured right now.
Yeah. That's the mic drop moment.
And that's the thing. If you're not designing for tokenization, decentralization, and contextualization, you're building on sand.
Yeah, which takes us back to sort of, was it episode 6 where we talked about the new interchange, and even I'll take this back to episode 3 where we talked about stable coins, and we're exactly an extension of everything we spoke about then.
Yeah, and we love it, but people take, like referring back to our episodes. But exactly, tokenization is the plumbing of that interchange, the mechanism that will let money, assets, and identity flow along with security, intelligence, and speed, like you've talked about, Zubin, earlier. And the future of finance won't be built by making things just bigger. It will be built by making things smaller, smarter, and more connected, until moving $1 billion feels as effortless as buying a capsule toy for Zubin in Shibuya.
Well, that's it for this episode of A to Z for FinTech, or A to Z as Aman likes to call it. Subscribe, share, and next time you tap your phone, remember, it's not magic, it's tokenization.
Thank you.